Welcome to Morningstar's Ask the Expert. I'm Holly Black. With me in the studio today is Dan Kemp. He is Chief Investment Officer at Morningstar Investment Management. Hello.
Hello, Holly.
So today we are here to talk about ESG, quite the buzzword in investment at the moment. What does it mean?
Okay, so that's a really big question. The simple answer is that ESG is an acronym, and it means environmental, social and governance. And those are the three areas that investors look for when thinking about how sustainable a company is. So are they doing things which will damage the environment? Are they doing things that damages society? Or are they running companies with poor governance, which could ultimately lead to damaging that company's prospects in the long term? And so really it's just a way of highlighting more sustainable companies and directing investment ultimately towards those more sustainable companies.
But I'm an investor. I just want to put my money in the fund and see it grow. Why should I care?
Well, that's a really good question, and it stems from the fact that when you're investing in a fund, when you're saving for retirement, then typically you become an owner, a part owner of lots of different companies. And of course, as an owner, people feel responsible for how their money is invested and what it is that they own. So in the same way that people will choose to recycle, will pick up their litter, will want to make sure that they're donating to charities that are aligned to their views of the world, then often people want to make sure their portfolios are aligned to those views as well. So many people would feel uncomfortable owning a company, part owning a company, that pollutes a great deal, much more than normal, or that uses sweatshops, for example, or has unethical practices or poor governance. And so ESG is simply a way of integrating your worldview with your investment portfolio.
I suppose one of the things that stops people from investing in ESG and sustainable and ethical funds is there is this sort of feeling that if you are ruling out certain companies, then you're limiting your potential investment returns. Is that true?
Well, it's a really good point for people to think through. And the first thing to say is that ESG covers a very broad range of investment types and ways of investing. And so in some cases, you're right that a ESG fund could exclude a whole range of possible investments, leading to a very narrow subset of the overall investment universe that people can invest in. And that could result in people excluding companies with good prospects. There are other forms of ESG which are really focused around simply investing in the best companies from a sustainability point of view in each sector, rather than exclusion. And a third strand where investors are simply looking to engage with those companies and improve what they're doing rather than use ESG as a selection criteria. So there's a whole range of possible opportunities for investors, and it's really important that either they do the work to understand how they're investing and which is relevant to them, or that they're using a financial advisor that's an expert in that area that can help them. But in reality, we have to remember that for most ESG strategies, the companies that you'll invest in are a subset of the overall investment universe in some way. And so if that subset comprises the most expensive stocks, which could happen, then yes, it could affect returns. Equally, it's entirely possible that an ESG index could do better than a conventional index simply because of the way that it's weighted. And so the key thing for investors is to really understand what it is that they're buying, what they're excluding, and how that could impact their portfolio over the long term.
Dan, thanks so much for your time, and thanks for joining us.